and I hope everyone's doing well, even though the market, I think, was down today. A couple of percent. Easy come, easy go. So hope you're having a great day. Give me a thumbs up in the chat that you can hear and see me. That would be great. I got kind of a number of things I want to cover quickly before we sort of jump into the show. First of all, every now and again, I'll be out in the wild somewhere, and someone I don't know will say, "Thanks, Steve, for the thumbs up." No, that's not what they said. That's just what I said. What they'll say is, "Are you Rob Berger?" And I always have, this is someone that knows me from YouTube, and that happened this week at a restaurant. My in-laws took my wife and I and family to dinner to celebrate our 34th wedding anniversary. And a viewer named James, who may be watching, I don't know, said hello to me. If you do see me in the wild, do say hello. I love meeting people, even if it's just for, a 10-second exchange and whatnot. It's funny to me that in this great big world of ours, I've run into a lot of people that know me from the YouTube channel. So I don't know, I'm surprised. Anyway, I see Philip asking about Truman. Is it worth the 900 pages? I think it is, but it actually brings up this. I wanted to read this to you, not the whole book, just couple of sentences. So here's the deal. Andrew Jackson, right? He was the 7th president, if I've got my counting right. He was elected in 1828. One of the big issues during he served 2 terms during his administration was nullification. It was this idea that states could pick and choose what federal laws they wanted to obey and enforce. The issue came up specifically with South Carolina and a tariff that hurt their economy, kind of helped the North. And there was a big move to say, we're not going to live by this tariff. We're not going to enforce it. And there was a big threat of, could we go to war over this? Civil war. Were they going to try to succeed? And of course, that didn't happen, obviously, at least not then. Andrew Jackson was, I think, a big reason why. I mean, the truth is, I don't think anyone doubted that if push came to shove, he was going to fight. I mean, he was, a general, was well known for the Battle of New Orleans and the War of 1812. He was not someone to mess with. But there was, of course, a lot more political maneuvering and all of that. But it got resolved peacefully. Henry Clay from, I guess, Tennessee, right? I think, or maybe Kentucky. Anyway, Senator Clay played a big role in it. But I wanted to read you something that I just find fascinating. So we're talking 1833 now. Just a couple sentences. 2 months sort of after all of this got resolved, on Wednesday, May 1st, 1833, Jackson observed in a letter that, quote, "The tariff was only the pretext, and disunion and Southern Confederacy the real object. The next pretext will be the Negro or slave question," end quote. 6 days later, the president named a postmaster for New Salem, Illinois, a 24-year-old lawyer who had lost a race for the state legislature. He was a Clay man, meaning Henry Clay, supported him, I guess, for president. But the post was hardly significant, and Abraham Lincoln was happy to accept the appointment. That just gives me chills. You got to love history. Okay, that's my history lesson for tonight. Great book. It started off slow because there's a lot of, the first half of the book is all about one of the cabinet members. His name was Eaton, and his wife Margaret, and the brouhaha they created in Washington and with the cabinet. He ended up dismissing, I think, the entire cabinet. And that was a big issue, which I get it. But anyway, definitely a good biography. All right. So we're going to talk first about buying Treasury bills. I just wanted to show you this because a lot of people have asked me about it. People want to know, should I get a no penalty CD? Should I get a brokered CD? Should I buy Treasuries? Should I do a CD ladder? All of these are good options. You can pick one. You can do a little bit of all of them if you want. But I do think Treasury bills are a good option. I'm showing you this on Fidelity's website, but I think it more or less works the same way. And we're looking at new issues, which means these are being auctioned by the U.S. government. You might say, well, what are the alternatives? Well, you could buy a Treasury bill or bond or note, just different duration, different maturities, from another investor, right, on the secondary market. And you could do that at most brokerages, including Fidelity. We're looking tonight at new issues. And so for a new issue, you've got to wait for the auction, right? You've got to wait for the US government to actually sell the bond that you want. And if we come down here, what happens is they'll get listed a few days before their auction, which you can see here's this. I didn't mean to do that. Did that move things around? No. The settlement date here. So today's the 22nd. So this one's the 25th, 31st, 31st, 31st. And these are all treasuries. Some of them are longer dated, right? So like this one has a maturity date of 2029. But like this one's this one's a 4-week treasury bill, right? And you'll notice here, I don't know how well you can see this. I'll try to make it a little bigger. The expected yield is 1951. And you might say, well, wait a minute. What do you mean an expected yield? I don't know if I'm going to buy this now. Do I buy this now? I actually got on the phone with Fidelity. When should I buy them? The settlement date in this case is the 25th. And they just said you could put the trade in now, but here's the reality: is you won't know the price and therefore the yield until the auction happens. So, we come back to this. It says the expected yield is 1.951. That may or may not, of course, be the actual yield. In my case, I bought 6-month bills, and I think when I put the trade in, I think it was like 290, but the yield ended up being over 3%. So that was kind of nice, I guess. And so you literally buy them in. Each bond is $1,000. Now, the thing that can be a little confusing with treasury bills is that they're what are called zero coupon bonds. They don't pay interest. If you get a 6-month treasury bill, you're not getting like interest compounded every month, or every 3 months. What happens is bonds are sold, at least through Fidelity. I guess this may be true everywhere, but in increments of $1,000. So let's just say you invest $1,000 in a 4-week treasury bill. Your actual cost will be something less than $1,000. Let's just say it's $980, just to pick a number. So if you've got $1,000 in your account and you buy this treasury bill, after you've purchased it, you'll see a line for your treasury bill, no different than you'd see a line for a stock or a mutual fund or an ETF, and it'll have a 980, and then you'll have $20 that you never spent that's still in your cash management account or cash, some sort of money market fund or wherever you keep your cash at your broker. And that's the way a zero coupon bond works. It's got, in this case, a face value of 1,000, but you're going to buy it for something less than that. And then, but when it matures, you get the full 1,000, and the difference is your interest. And they just calculate the yield, just some basic math. And it's really as simple as that. And I'm trying to think of what other thing I can say about it. It's not difficult. I will show you this. I'll pull this up on the screen. That's new issue. If you want to go into the secondary market, and let's see here. I'll just pull this up here in a second. Let me just get it on the screen. So these are treasury bonds in the secondary market. And what I've searched for are bonds that mature this year. The thing here to keep in mind, you can see coupon is 0 for some of these because those are 0 coupon. These are treasury bills. They don't, like I said, they don't pay interest in the normal way. But if you're going to buy on the secondary market, you could buy a treasury note. See, this one's a note, and you can see the stated coupon. What's that mean? Well, this was issued sometime in the past, and it just means that it's going to mature in the next, 5 months. So it still acts like a short-term, effectively like a short-term treasury bill, but it just happens to be a note. I mean, another way to think about it is, even a 30-year bond, when it's only got 6 months left before it matures, is at that point a short-term bond, right? 6 months left, and you can buy it. You're effectively buying it in the closing hours of its life. It's lived 29 and a half years, and you're going to buy it for the last 6 months. What you really need to look at are the yields, not so much the coupon. And you've got the bid and the ask, so that just like with stocks, there's a spread. They're usually fairly minimal. We're after hours on the market, so I don't know how that affects the bid and ask spreads. But you'll notice this depth of book and these quantity limits. And that confused me. I mean, not that the quantity limits are confusing, but like 500 is a limit. Well, goodness, $1,000 each. I don't, maybe you don't want to put $500,000 into this bond. But if you look at what's called the depth of book, you'll actually see there's quite a lot for sale. And some of them have much lower minimums. Like this one just has a $1,000 limit. I don't know how well you can see that on the screen. But the way this is supposed to work is if you want to buy this bond and you don't want to put $500,000 in, you only want to put 1,000 or 10,000 or whatever, you should actually be able to come back over here, hit buy, put in how much you want, and it should direct your trade to effectively a seller that will work with those limits. Sometimes that doesn't work though, but you can always go to depth of book and actually buy, like pick the specific one you want that's got the limits that work for you. Hope that makes sense. At the moment, I don't really see a particular need to get into the secondary market. It just seems to add a little complexity. I guess it's not that complex, but yeah. I don't really feel a need to do that. I guess you could. I mean, there might be a reason to. I'm not an expert bond trader, but I have found buying treasuries through broker pretty easy. I mean, it's, not that complicated. Although Mike says this is why he's willing to pay a few cents for a mutual fund. Yeah, I hear you. Okay, one last thing that I wanted to show you. Someone sent me this article. Here was the article they sent me on Yahoo Finance that says, JP Morgan says you can safely withdraw this much from your retirement accounts yearly. And I had to dig in to find the article. Here it is. This is on privatebanking.jpmorgan.com. Published just a couple of days ago. And what they say is right here, how much might we safely spend every year in retirement? Our analysis suggests the number is likely to be around 2 to 3%. Now, they don't really say, they don't give any data really. They basically say because their expected stock returns are low. What they think will happen in the stock market, they're not all that excited about it, and inflation. I really found this article though surprisingly bad, or maybe the analysis. So, for example, they refer to this 4% rule, and then they say right here, you probably could expect to spend around 4% of your assets annually, and would be unlikely to run out of money during the rest of your years. And then they say no longer. Well, problem number one with that is that's not the 4% rule. 4% rule doesn't say you can spend 4% of your assets every year. It says you can spend 4% in the first year and then adjust that amount by inflation going forward. If you literally just took 4% of your portfolio every year, that's actually a much more, I guess, conservative approach. The problem with it is you could end up, particularly if the market is down and inflation is high, having trouble paying all your expenses. But that was the first problem I had with it. They misdescribed the 4% rule. Then they say, the financial planner who devised the 4% rule has declared it invalid due to lower returns and higher inflation. Well, we had Bill Bengen on the show. Contrary to this claim, he's actually put it now at 4.7% with the right asset allocation. Now, I'm not sure I agree with that, but he's certainly not ruled it invalid since he was on the show a couple of weeks ago, he's published something that I haven't seen. And if anyone knows of anything, please let me know. And here's the thing. I don't know what the future is going to hold, but the 4% rule survives all the way back to 1871. That's how far the analysis has gone back now, through some really bad stock market returns. I think the Great Depression was terrible, the 70s. And inflation that ran double digits effectively for a decade or more. Now, could that happen again? Sure, anything can happen again. Maybe it'll be worse, but it hasn't yet, and we're not even anywhere near close to that kind of bad. So I don't know what's going on with JP Morgan. Of course, watch, 30 years from now, they'll be proven right. All right. All right. I'm going to dive into some questions. I do have a portfolio that I'm going to show you tonight, but I'm going to get into some questions first. So Mike is doing some T-bills between 8-week and 4 weeks. So I'm personally not a fan of those myself. And let me see if I can show you why. Bear with me. So if we look at the yields right now, well, yeah, you said 2 and 8 week. It's funny, I don't actually, I'll pull them up somewhere else. I don't actually see them here. Treasury yields. I can get these. Let's see if they'll show me here. Here we go. So, and I'll move this above the comment. So here's the 4-week, the coupon equivalent. I don't know how well you can see that. It's 218. Oh, actually, let me get more recent. 221, the most recent down here. 8-week is 253. I can get a no penalty CD at 270, which we've talked about in the past. So for me, you know, I would just do that over these shorter duration, because I can pull the money out anytime after 7 days from the no penalty CD, which is why I ended up going, I think, 26 weeks. Oops. Coupon equivalent would be 3.20 right now. It's a little higher than what I got. That's just my own view of things. So you see me, but you're laughing with, I don't know, do I look funny? What happened? I don't know why you guys are you laughing at me? Noreen, thank you. I think my wife deserves most of the congratulations. She's survived me for over 3 decades. By the way, I'm cruising through books. I finished American Lion, the biography of Andrew Jackson, and now I'm back to Bernanke's book, which is phenomenal. I'm only about 75 pages in, but he writes with such clarity. It's the kind of book where I'm reading it and I think, well, now feel like I've got a PhD in economics. I understand everything he's saying. The clarity of his writing is perfect. It makes sense. And the history, it's interesting to see the mistakes that the Fed made leading up to and in through the inflation of the 70s and early 80s. Of course, it's always easy to, hindsight's 2020, so it's always easy to look back. Philip, I look forward to meeting you at the Boglehead conference as well. Yeah, if folks are going, maybe we'll get together. I don't know, we'll have to figure it out when we get there, probably. I have the Truman biography somewhere, but I'm reading the biographies in order, although I read Truman years ago when it first came out. That was McCullough, right? I could be wrong. If I could type. Was it? Yeah, it's McCullough. Yeah. I get more 404 arrows on Amazon lately. I don't know what's going on there. It's got to be operator error. Anyway, I'm just trying to show you the book. Here's the paperback version. Right here. Yeah, it's not a quick read. All right. This is an interesting comment. If you had 1 million, the dollar sign, I'm guessing, was a typo. Although, if you want to give me $1 million, no, actually, I don't want it. If you had, yeah, if you had 1 million subscribers, you'd be widely recognized. Oh, I see. This is in reference to people recognizing me in the wild. But that is not going to happen with a financial channel that offers sensible advice. Well, on the one hand, I thank you, but on the other hand, I don't know. I think we should aim high. I think we should go for $1 million. Okay. So Noreen wants to know about a stable value fund. I mean, I guess part of it would be some question. Now, I've never owned a stable value fund. To my knowledge, I've never had access to one in any of my 401ks. But what's the interest rate, right? What's the guaranteed rate? What are the fees? Would be two big questions that come to mind. And presumably, if you did invest in it, it would be, I assume, part of your fixed income allocation. And I think you just have to analyze those things. Yeah, I think it would just depend on those things. I've never had one. I don't think. I know I've not invested in one. I see all the comments about Andrew Jackson. Kind of in some ways, a sad life. He lost, his father was out of the picture. I don't know if he died. I can't remember now. But his mom died when he was young. His brother died. He never had children. His wife died, Rachel. I think after he was elected, but certainly before he went to Washington. Yeah, and he had a lot of health issues. All right, going through the questions here. Sometimes if I skip a question, it might simply be because I don't feel like I have anything intelligent to say about it. But this show could be over quick. I'll just zoom right through them all. I don't know. I'm going to just pull this question up because it starts out, if you were 23 again. I don't even remember 23. How far would you be comfortable leaning into mid small cap? I personally lean 40 to 50% of my equities in my 95/5 portfolio. Well, I started investing about that age, maybe a couple of years older, because it was after law school. And once I kind of figured out what I was doing, or at least thought I knew what I was doing, and that took me a couple of years, I didn't tilt my portfolio beyond about 10% towards small cap. And that's what I was comfortable doing. The thing is that the more you tilt a portfolio like to small cap, for example, or extreme value or extreme growth, you have to be prepared to significantly underperform the market for long periods of time. And it struck me as taking a risk that I wasn't confident made sense for me or that would pay off in the end. So I just wasn't comfortable going beyond about 10% for a small cap. That was me. I don't think that's changed in my mind. I don't think I would change that today. You are welcome. Wow. You're all in. Okay. Yeah, you've got more nerves of steel than I do. That's something. So, Sergio says, I saw that article in your newsletter about Vanguard's active versus passive. What are your thoughts on it? So, first of all, if you don't get the newsletter, you can subscribe below the video. There's a link. It goes out on Sundays. And there was an article, actually, one of you all sent it to me. But it was on Morningstar. Let's see if I can pull it up real quick. Yeah, here it is. Investors are shunning Vanguard's best fund. So I have not dug into the data on this, and I don't even know how much data he discloses. But a couple of things caught my attention. The first is it's based on data from 2017. So this is not a long-term study, number one. But by the way, the upshot of this article was that several of Vanguard's actively managed funds did better than their index funds on a risk-adjusted basis. And so, that's also a question for me. And I understand I understand that perspective, but I just haven't dug into it yet to look at data. I didn't even know if he provided it. So the idea, if I'm reading these charts, for example, these are active funds, and effectively the lower the bar, the better, right? It's comparing it. And the other thing is, what's it comparing it to? It's got to be comparing it to whatever category these funds fall into. But that can still be tricky as well. Do they deviate from the category, and how and what ways? But he is looking at risk-adjusted returns. And I noticed, by the way, the one thing that caught my eye was how well Wellesley and Wellington have performed. Now, the index funds, they're up here, I think. Yeah. And some of them are like right in the middle, which you'd kind of almost expect for like a total stock fund. But in 500, the S&P 500 has done really well over the last 5 years. But I just didn't see the data that would lead me to form a strong opinion about this article. Of course, I read it, put it in the newsletter. I think it's interesting, but I need to do, the long and short of it is, I need to do more research to understand what I think of it. Well, the first thing is, I do think the Fed will continue to raise rates, but there's no guarantee of that. But I feel pretty confident they will. That doesn't necessarily mean yields will go up, right, on treasuries. It makes sense that they might, but the yields are a function of a lot more than just what the Fed's short-term interest rates are that banks pay as they lend money to one another. So 4 to 8 weeks is a very, very short period of time. So you are sacrificing yield to do that. Even compared to, say, a 6-month treasury bill. So, that's why if that were my concern and I thought yields were going to go up, I would be more inclined to do like a no penalty CD, which I think they're still at 270. The ones that we've talked about in the past. Yeah, they are. But that's just my thinking. Well, this is good. So Dave says he's been doing the same thing in terms of T-bills at Vanguard, and it's pretty much the same in terms of the the process and what you'll encounter. And I think it's very similar at Schwab. You do get a tax advantage right on the treasuries. There's no state and local income tax. So that's something that, depending on your situation, may or may not be important, or more important, less important, depends. But all right, going through the questions here. Yeah, bonds can be. People are saying that bonds can be confusing. They can be a little counterintuitive the way they work. I'm not sure I understand this question, Jordan, but it's an interesting one. I'm a super saver. Good for you. Should I use unfavorable funds in my 401k for specific asset classes for tax efficiency, or use brokerage for funds I want to use? So I'm guessing the way I understand your question would be, there are certain asset classes you'd prefer not to invest in a taxable account. However, the funds for those asset classes in your 401k are not great. Presumably they're expensive, I'm guessing. And so what should you do? Well, just some things to think about. The first is, there are benefits to investing in a 401k. You might have a company match, and there's just tax advantages. And so my analysis was always, how expensive are these funds, and how long do I expect to be at this company because I might be willing to accept a higher expense ratio than what I'd normally be comfortable with for a relatively short period of time. And if they're really tax inefficient, I might end up losing in taxes. I mean, again, you have to do the math and think it through. But even if you avoided the 401k, you lose the tax advantages. You might lose the match if you have it. And then you end up in these asset classes that aren't tax efficient in a taxable account. That's going to cost you tax wise. Of course, depending on what the asset classes are, how important are they? Do you have to have them? I don't know what asset classes you're talking about, but those might be questions that I would sort of start to think about. All right, let me show you the portfolio. This came from a viewer named Brian, and I'm using a couple of tools to show it to you. First is personal capital. So this is a demo account. I just keep adding portfolios. Look, we're up to $7 million. Man, you guys are great. Let me get rid of the comment. The portfolio we're looking at is, actually, we'll go to holdings first. And I've got to clear all the accounts, and it's this one. And here's what Brian owns. And you'll see these are fairly expensive. This is a small cap fund, global discovery fund, extended market. So think things beyond the S&P 500, and then Fidelity's Contra fund. And I just threw it in. I got close to $1 million portfolio. I don't know the value, but the percentages are roughly in line with Brian's portfolio, right? The reason I put it in personal capital to begin with, there's two reasons. I like the way they give you a view of your asset allocation, which I'll show you here. And I also like their analysis of fees. So let's start there. So we'll go to allocation. So one thing to keep in mind with personal capital, with US stocks, they give you the breakdown based on both small, mid, and large cap, as well as value and growth. So if we just pop into US stocks, you can see all the boxes, right? So the small cap boxes are on the bottom, mid cap, large cap. And very quickly, you see, boy, there's a lot of small cap exposure here. Again, it's funny, we talked about that just a minute ago, but when you add up the numbers here, you're looking at 27, 35, 36, 36.5%. So one question for this portfolio I would have is, what's the thinking behind that much small cap exposure? Second is a question, right? I'm not here to tell you what's right and wrong, but maybe I am to some degree, but not in this context, because I'm not here to give you guys any investing advice. These are just my views on things, and you have to make your own decision. So this is just a question: why so much small cap? Why so much large cap growth? And if you click into any one of these, we'll do large cap growth. It'll show you where most of the exposure is coming from. In this case, it's Fidelity's Contra fund. But why so much growth? In other words, the question I would have for Brian is that on purpose? Or is this news to you? Did he not know that he had this kind of exposure? I don't know. But this is the kind of thing that portfolio, that personal capital can show you pretty quickly. On the one thing I want to note, though, is on international stocks, you don't get that level of detail. What you get are a breakdown just between developed and emerging. If we go to developed, it'll show you what funds give you exposure to developed countries, but it doesn't break it down between value and growth, small, mid cap, and large cap. But still, I think a great asset allocation tool. So the other question then, beyond the ones I mentioned on U.S. stocks, are why just 7.85% international stocks? Again, is that on purpose? And if so, what's the purpose behind that? Question. And then there's almost no bonds, right? There's effectively no bonds. A little bit of cash that some of the funds hold. So what's your thinking there? Those would be questions on the asset allocation front. Again, it's not that 100% stocks is a bad portfolio. It's a very volatile portfolio, and you need to be prepared for a wild ride. So those are questions on the asset allocation. Then we can go over to get to the investing fee analysis. You actually go to planning and retirement fee analyzer. And you have to make sure you've got, well, if this were your own personal capital account or my own personal capital account, presumably you just select all accounts. But here we just want Brian's, it's right there. And you can see 73 basis points. I'm not sure how well you can see that. So that's pretty expensive. I mean, it's not outrageous, right? You can certainly, with actively managed funds, be well above 1% for sure. But 73 basis points, again, it'd be a question for Brian, why, and by the way, in his email to me, he recognizes that that's on the high side and is considering, I think, maybe going with index funds. The one thing I like about this tool, I've shown you this before. I've got an assumption in here that the person's 42. I have no idea how old Brian is. So what you can do is you can edit the assumptions, and we can say, okay, we're going to retire at age 67. And so it says, okay, from the age of 42 to 67, assuming this expense ratio, assuming you contribute $6,000 a year, and you get an average return of, we've got it at 7.6%. The total fees, including the lost compounding, about $1 million. That's pretty significant. Now, yeah, so I really like this tool to analyze that. Okay, so then what I did was I looked at it in Portfolio Visualizer. So I put in the 4 funds, and if you analyze it, what I wanted to do, actually, before we look at it, I wanted to compare this to just VTI, since this is basically a 100% equity portfolio. And we'll put in 93, because remember he had 7% in foreign, so we'll just do VXUS 7%. What kind of data does this give us? Okay, it gives us, you can see here, 10 years, 11 years of data. And in this case, this is interesting, I think. The simple 2-fund portfolio outperformed. Now, again, this is over just 10 or 11 years. I don't know what the future holds. But you can see the compound annual growth rate is 13 for the simple 2-fund index fund portfolio, and it's 12 and change for Brian's portfolio. Now, I tend not to try to read too much into that for all the reasons we've discussed about historical data, but I do think it's at least a relevant data point. But the other thing that caught my eye was look at the standard deviation. The simple 2-fund portfolio achieved higher compound annual growth rate at significantly lower volatility, 14.15 standard deviation versus almost 16%. And that was pretty telling to me. So again, not here to tell Brian what he should do or what any of you should do, but these would be questions that I would have. Why do you believe in this portfolio, given the questions about it, the asset allocation we've talked about, given its expenses and the impact that can have on the portfolio, given admittedly limited data, a decade or so, but the returns and the standard deviation that we see in this portfolio, why do you have confidence in this portfolio? Again, I'm not suggesting that, I compared this to portfolio 2. My point isn't that that should be your portfolio. It was just a very simple way to look at a comparison. And I kind of walk through this, not in part because this is at least how I think through any investment portfolio, kind of, the steps that I went through just now. It doesn't take long. I'm sure there's a lot more you could do. We could have put each fund into Morningstar and done a deep dive on each fund. And certainly you could do that for your own. And we'll do that as you guys mentioned funds tonight. I'm sure we'll look at others. But that was my take on it. Those would be questions that I would have for someone considering this portfolio. And so there you go. All right. That's my take on the portfolio. Kim, I don't know, Fidelity has their, what's it called now? Brokerage link, where you can invest in just about anything. I'm guessing you could invest in Treasury bonds, bills, and notes, but I don't actually know that. I had access to Brokerage Link at one point, but I don't have a Fidelity. Or oh, you're talking about traditional IRA. I'm sorry, my mistake. Yeah, I don't know why not. Now, you get a tax advantage, right? Because you don't pay state and local income tax. So but you do pay, of course, federal income tax. So on the interest, I'm not sure. I have to think through where I'd want to hold these. Huh, a good question. Because normally I want bonds in my retirement, in my traditional IRA is a perfect place. So I don't know. Depends on your circumstances. I don't know that the lack of state and local income tax would dissuade me from keeping them in a traditional IRA. I happen to own mine in a taxable account, but that's just because I need the money soon. But yeah, I'm pretty sure you can. I just have never tried it. So maybe someone else has and they can answer the question. So MW, you're absolutely right. Bill Bengen's paper assumed a 30-year retirement. He did look at the numbers going out 50 years, but it's a 30-year retirement. And I'll show you a resource. Big Earn, not his name, it's his nickname. Early Retirement Now, ERN. See what he did there, or someone who gave him that nickname? I'm actually reading through this now, but he has a safe withdrawal rate series. If you go to Early Retirement Now, let me close this. Here's the series. Now it's a lot. I mean, you'll spend hours if you read through all of this. I think he's written 30 or 40 articles. Let's see. Oops. Here's part 37. So yeah, it's a long. Oh, here's part 42. Yeah, it's a long series, but I mention it because, as the name of his site suggests, he's very much focused on early retirement. So if that's important to any of you, I don't know that it's interesting. I'm still reading through his, and I'm really just towards the beginning. I have a lot of questions about the way he's thinking through things, and I am going to reach out to him to see if he wants to come on the show. One of the things he does that I would want to ask him about is his assumption is he rebalances every month. And I don't know why he would assume that or why he would do that. I'm sure he's got a good reason for it. I just don't know what it is. I certainly wouldn't rebalance monthly, but there's no, so what, right? I mean, there's more than one way to do all this. All right. Oh boy, Mike. I have no idea of a small cap value. Well, does Vanguard, let's see here, Vanguard small cap value Canadian fund. No, nothing's coming up. Yeah, I don't know. Wish I could help you. Don't know. Ethan, it's a great question, but I'm not. I mean, CoastFi, as I understand it, is that you get to a point where you've saved enough money where you don't have to save any more, and you can just let the money you've saved compound to retire. But I don't know. I'm not sure I would think of quitting my job in the context of CoastFi, financial independence. And maybe let me just make sure I've got the right thinking here. Yeah. Yeah. So my understanding of CoastFi is correct. By the way, I just Googled this. I don't know. There's a calculator here that might be useful to you. It's on walletburst.com. But back to your question, I find it very difficult to answer the question about retirement and retirement readiness. Because if you're going to quit your job, it's kind of no longer CoastFi. I mean, presumably you're going to have to start pulling money from your investments, right? Although you say quit my job and lower my income. Does that mean live on less, or you're still going to have some form of income? I guess those are questions. You can certainly do the math. And if you're going to do early retirement, and I don't know that you actually say early retirement. I've got a lot of questions, Ethan. What age do you want to retire? Are you quitting completely and you have no income and you're just going to live off your investments? If so, I'm not sure CoastFi is the right way to think about it. But I think I just need more info. Conscience, not specifically. I do think AVUV is a very interesting fund. I've not run out and bought shares of it, but it's a small cap, and it's a more value fund, and I like that about it. Now I don't. Let's look at these other tickers real quick. Oh yeah, so the other one was VIOV is Vanguard's small cap 600, which I think is smaller than like their VBR, right? Let's take a look at the portfolio. Yeah, it's really small. But I've not compared AVUV to this one. I think AVUV is not this small, but maybe a little more value. Let's find out. Yeah, it's close. Maybe a little more value. I've not compared the two though. Let's clear these. I guess comparing them is not going to help us, is it? Because there's just not enough data. We can try it, but it's what? It's going to be 3 years. Yeah, 2.5. It's meaningless. Just not enough data. Although, for what it's worth, Avantis has outperformed. We can put the third one in too. What was that? VTWV. This one's going to be a larger cap, right? Whoops. At least I think it is. VTWV. Whoops. Where's my Morningstar? Here we go. I got too many tabs open. Got to be bigger, right? No, it's not. It's interesting. It's not much difference. But again, if you put them all three in, you've only got 2.5 years of data. So I've not dug into them enough to have a strong opinion. They all look similar. So I don't have a strong opinion. The thing about that, you'll hear people talk and they'll have a strong opinion, and that's okay, right? I mean, I have strong opinions about some things. I don't really have a strong opinion about these funds because I haven't done the work to justify a strong opinion. And I think it's important to recognize that limitation as you're doing your own analysis. When people tell me their opinions, I'm almost more interested in why they believe what they believe than what they actually believe. And I just haven't done the work. It's like, I'll give you an example, and not to get into politics, but the whole thing about to what extent is the climate change caused by human conduct? I know I've just set it off, right? People are like, oh, Rob, third rail, don't talk about that. But the reality is, I'm not a climate scientist, obviously, but I've not even done in-depth reading to feel like I know what all of the issues are. I mean, you hear about things in the news, you read an article in the New York Times, maybe. That's about the extent of my, knowledge of the issue. It's not great. So when I hear people have a very strong opinion on this, I really do honestly want to know why their opinion is. Either way, I don't, you think it's caused by, human conduct. It's not. I'm interested in why. And So when it comes to investing, I'm really trying to be careful about what I feel confident about, what I really truly believe, and why I believe it. That's why, we talk about small cap value. I'm always interested, and I asked Paul Merriman this, but it's okay. Why has it done better? It has done better over the last 50 years or whatever, but why? And why are we confident it will continue to do better? I still don't have an answer to that I feel strongly about. Probably easier. Maybe it's not easier than the climate issue. I don't know. Maybe I should give up the whole investing thing and become a climate scientist. Probably too much schooling involved with that. All right. So, photo guy says, in retirement, taking RMDs, I've always reinvested dividends in retirement IRA accounts. Sometimes I need to withdraw more than the required minimum distribution. Should I just take dividends in cash? So it's important that your question is about dividends in an IRA, because you can reinvest the dividends and then take them out later or not. It's not good. Whether you reinvest them or not, it's not in and of itself not going to affect you from a tax perspective. Of course, what will affect you is when you take them out. If it were a taxable account, the way I would do it, if I were going to need the money soon, say spend it this year, I wouldn't reinvest it. I generally don't reinvest dividends automatically in a taxable account anyway, because even if I'm going to invest it and not spend it, I want to decide where it goes. Because as we all know, if it gets automatically reinvested in something and you wanted it in something else, depending on how long it's there, you take it out, you could have some taxes. But in an IRA account, you don't have that issue. So in my mind, it really comes down to a question of convenience. You could probably, depending on where your IRA is, and I'm not to the age where I'm taking money out of an IRA account, so correct me if I'm wrong, but I'm going to assume, which is a dangerous thing to do, but I'm going to do it anyway, that you could set it up so that the dividends get automatically paid out of your IRA account, if that's what you want to do, keeping in mind taxes. But if you plan to spend the money in the next month or two, that might make sense. That might be some, just a convenience factor. But for me, I personally just reinvest all of my dividends inside my retirement accounts, and I'll probably always do that. And then when I need the money, just take it out. Right, because the taxes are going to be based on every dollar that comes out of the IRA account, assuming that it's a traditional IRA and there's taxes. So I guess it could be an after-tax IRA. So but assuming that it's taxable income when you pull the money out, I would probably just reinvest it and just take it out when I need it. Probably what I would do. But I don't think there's a wrong answer here. As soon as I say that, there's probably some answer that's wrong. But I don't know what it would be. Yeah. Vacation Time 247 informs us that the 4-week T-bill is currently yielding 2.18%. Thank you. Marty, it's interesting. I wonder, would it be useful? I guess it would be useful, but we could also end up drawing the wrong conclusions, perhaps, even if we knew what the rates will be 6 months or a year from now. I will tell you one of the things that I found very useful in the Ben Bernanke book is just how unpredictable these things are, and because he goes through a history going back into the 50s. Well, he goes back to the Great Depression, but it starts in the 50s, I think, I guess it goes back to the Great Depression. But when you get into the sort of the Great Inflation and all that, gets into the 70s, and he's talking about unemployment and inflation, which have a relationship to one another sometimes. I guess they always do. It's just that relationship can change. And it really puts into perspective how quickly things can change, how unpredictable they are, how some of the greatest economic minds in the world get it wrong. I mean, if that book has taught me anything, I already believed this, but is that I cannot, nor should I try to predict interest rates, or certainly invest based on a prediction. I do predict they will fluctuate. Okay. What's the title of the book? I forget. I'm old. What can I tell you? It's upstairs. I have a routine. So I read in what I now call our library, which is just a living room with a bookshelf. But I like to call it a library. And every morning now I get up and I read there. I have a nice view out the front windows of the house. And here's the book, 21st Century Monetary Policy. And I get another, when I click on an Amazon link from Google search results, I get a 404 error. Can someone get Jeff on the line for me? Ridiculous. So I'll go to a different website. Here's the book. It's really good. Yeah. I'm really looking forward to what he has to say about the present. I'm up into so Greenspan, he's doing his thing. We're in the 90s. Yeah. It's interesting. Politicians, it's not easy, because if you want to check inflation, you've got to do things that can hurt the economy, right? Can cause a recession, can trigger more unemployment. And who wants to do that? And politicians in particular don't want to do that, particularly presidents who are who are running for re-election. And so, it's not an overly political book at all, which is good. But he talks about Nixon and Carter. It's interesting. One of the things he said about Carter, by the way, was that so Carter appointed Volcker, who, of course, beat inflation into submission, very painful. But he kind of gives Carter some credit, although he did point out he's not completely sure Carter knew exactly what he was getting into, and apparently he tried to find a couple of other people to take the job first. But it's not easy, for a president to appoint someone that's going to raise interest rates significantly, potentially put the economy into recession right before an election, and but it can cause us, if we give into those. I shouldn't put it that way, but if we're not willing to do those hard things, inflation can cause, as we know, pretty significant damage to an economy. Anyway, it's good. It's a good book so far. Can you show the John Quincy Adams book? Yeah, it's upstairs, but I can Google it, click on the Amazon link, and then watch it 404. Well, I can show you the one that I read. Here it is. Oh, it works. Here we go. This is the one I read. Good book. I think this is the one I read. Militant Spirit. Yeah, I'm pretty sure. His best days as a politician, I think, were in the House after he was president. His presidency was, I think in the chat there are people talking about who would win in a fist fight between myself and John Bogle. Am I reading the comment correctly? What in the world is going on? It's like Thunderdome with you guys. I didn't know this, that Truman did not have a college degree. I didn't know that. So, what are your thoughts on Merriman's 100% small cap value for first 5 years of a Roth IRA for recent grad? I would not be a fan of that. I mean, I love Paul. First of all, you're basically betting not that small cap value will outperform over some long period of time, but that it'll happen to do it in the 5 years after your graduation. And I worry too that it sets the wrong, I want to say precedent, but I kind of want to build a foundation for an investor that can last them a lifetime. That doesn't mean they won't ever change anything. But this idea we're going to go an extremely narrow portfolio, I guess in the hopes that during that 5 years it outperforms, and then we're going to diversify. I just don't care for that. I'm not totally opposed to the idea that when you start out, I mean, I remember helping a family member years ago, and they were just starting out and, putting a couple $100 a month aside. I said, just put it in an S&P 500 index fund for now. Get a couple $1,000s in there, 5,000, whatever, and then start to diversify. So I'm not totally opposed to that concept, but I don't think if someone came to me and said, hey, can you help me set up an IRA or whatever, what should I invest in? I would not say 100% small cap value. Yeah. But Paul's a smart guy, so you should listen to what he has to say and then, consider your options, make your own choice. Ethan wants my thoughts on VSIAX. Is that just the S&P? Oh, no, it's small cap value. So, which must be the same thing as VBR. Here it is. Yeah, I think that's the same. Let me just make sure. One way to figure this out is if you go to the Vanguard website. So here we are. So this is VBR, which is an ETF, Vanguard Small Cap Value. Also available as Admiral shares. So if we click that, it'll take us to the Admiral shares page, and sure enough, it's VSIAX. So they're effectively one and the same fund. Okay. So, all right. So that's the first one you want to look at, and I'll look at it in a second when we've looked at it before. FI, this must be a Fidelity fund. Must be a Fidelity small cap fund. I'm mistyping it though. Yeah, so this is a Fidelity fund. So let's start with the Vanguard fund because I'm familiar with this one and I own it. I own shares of this. But if I were buying small cap value today, I would probably pick something like AVUV or one of those other Vanguard funds we looked at earlier, because it's smaller cap. This is really sort of a small mid cap fund. If we go to weights, you can see that. And it does tilt a little to small, but it's got what, 20, 30, 40% roughly in mid cap funds. Now, maybe that's what you want. Maybe you want both of those, and in which case this could be a perfect fund, right? But for me, if I were going to wanting to get more exposure to small cap value, I'd want more tilt to small cap, and if I could, more tilt to value as well. So again, I think this is a great fund personally. It just depends on what you're after. Fidelity. Let's take a look at something here. What's the cost of this? Is it 7? Yeah, 7 basis points. Yield, it's 193, but you really need where's their SEC yield? Maybe it's under price. I don't know where it is. Well, you know what? I don't need that. I think it's one thing I don't like about Morningstar is where they put data differs between ETFs and mutual funds. I kind of get why. Anyway, SEC yield is 187. Okay. So for Fidelity, it's 5 basis points, so super cheap. Slightly lower yield. Let's look at the portfolio. So this one's smaller cap, right? So this would go into my funds to consider along with the other Vanguard funds and Avantis. Is it Avantis or Avantis? I feel like Avantis is how you would pronounce it if you were a little, I don't want to say snobbish, but Avantis, that's how you pronounce it if you're from Ohio. Okay. Anyway, I'm not really sure where all that came from. So how the trick is this. When you're dealing with these index funds, and we look at the portfolios, so there's some logic to, thinking through, okay, I want smaller cap, or maybe you don't. Maybe you like the mix of small and mid cap. But depending on what you want, okay, so let's assume you want smaller caps, and now you've got 3 or 4 funds to choose from. At the end of the day, this again is understanding what we can know and what we can't know. We can look at their investment philosophy. Most of these are index funds. AVUV is not, although I think they have some sort of standardized methodology, or maybe it's some algorithm, some quant-based way of picking stocks for their fund. But there's no way to know which one is going to outperform the others over the next, pick your time period. You just don't know. And so you have to pick one based on something other than a belief about its future performance, I think. And that also means that past performance doesn't help us a lot, because there's no way to know that it's going to repeat itself, particularly with something like Avantis, as I like to say. It's probably Avantis. Avantis, it's only got a couple of years. It's done really well, but it's a short time period. But I think they're good. I think they're all good. There you go. I'm not sure how helpful that was. That's a good question, JP. As a retiree and living off your investments, should one include Roth conversion taxes in the 4% rule? I don't know that. That's a tough question in my mind that I'm going to have to give some more thought to. Here's what's rattling through my brain. You have money in a traditional, let's just assume it's an IRA. You're going to have to pay taxes on it at some point. We know that. Well, assuming you take it out at some point. A Roth conversion basically allows you to accelerate those taxes, pay them now rather than later, right? So let's assume for a moment, let's put aside a Roth conversion. Let's assume you don't do that. The way I think about taxes, and this is not how everyone thinks about it, I view it as, you take out your whatever withdrawal methodology you're following. Let's assume 4%. You take out the money, and if you have to pay some taxes, it has to come out of that money. Now, the way Bill Bengen looks at it is different. He looks at it as starting with a smaller percentage. And he said that in the interview. I don't remember what the number was. It was 3 something. That seems overly complicated to me. You take out your 40 grand per million, and if some of it's taxable, you got to pay taxes out of the 40 grand. That just seems simple to me. And I think correct in any event. Then the question becomes, well, in effect, with a Roth conversion, you're basically taking taxes that you would have paid, 20 years from now, and moved them and paid them here in 2022. So could the argument be made that you won't take them out of your 4%, meaning you'll take them out of other money? You'll effectively withdraw more money that year, some of which goes to the IRS. It strikes me as if that is a feasible way to look at it. But I'm not positive. Man, I'm just like, this has been a tough night. Is it almost over? Not quite. That's a tough question. I'm going to do some research on that. Roth IRA conversion taxes, part of 4% withdrawal. Maybe Kitsis is, he's smarter than I am. Maybe he's come up with some great analysis. I don't know. I'm going to give that some more thought. This is why Noreen is the best moderator ever. Well, it's one of many reasons. Kevin wants to know, when you put T-bills on auto repurchase, do you get the new rate or the same rate you purchased at? Yeah, so I've not done the auto roll, but it's got to be the new rate, right? It's got to be, I think, because it would just be, another auction. Or even if, can you do that on the secondary market? I don't know, but even then you'd get whatever the price was at the time of the purchase. Gotta be. I mean, I guess you could call your broker and confirm. Like I said, I've not actually done that, but I don't know how it would be anything other than that. This is the longest question ever asked on the show, I think. Whenever you're discussing withdrawal strategies, the assumption always seems to be that some type of annual inflation adjustment will need to be made on an annual basis, notwithstanding a down market. However, let's say that you had a $2 and we got cut off. You ran out of room. Let me scroll down and see if I can find the rest of his question because I'm on the edge of my seat here. I don't see the. Craig, you're leaving us hanging. Where's the rest of your question? I don't know. Well, if we find the rest of that question, I'll do my best to answer it. You know, I responded to this earlier, but one thing I would suggest that you do is when you're thinking about these issues and you're trying to figure out what to do and you're not sure, write a note to yourself that you'll open up. You can use different note-taking apps to do this, but I've done that where I'll write a note to my future self and I'll say, I think in this case, I think I should invest in whatever 4-week T-bills that are yielding whatever 220, let's say, because in a month or two, yields will be up because the Fed will raise rates, and then it gives you a chance to see. This is what I was thinking then. Did it come? Is that what happened? And sometimes it will. Sometimes it'll work out. You predicted it perfectly. Other times maybe not. But I find that useful. And actually, it can be useful both ways. But for some reason, I find it more useful when I'm wrong. And fortunately, I have a lot of opportunity to learn from that. This is a new one to me. YouTuber walks and Wallstreet. Does he take a walk, or she? Is it a young man? Does he take a walk and? I'll have to check it out. I'm not familiar. Let me look at this question here. So the question is, would you buy TLT over T-bills? Well, TLT, I think, is iShares 20+ year Treasury bond. So the question really, I think, is, would I buy long-term bonds over short-term bills, right? For me, I would not be buying long-term bonds at the current yields, whether in the form of, and this, by the way, this is the ETF that I think you're referring to. I wouldn't buy long-term bonds personally, whether it's part of an ETF like this or individual bonds. I just think the interest rate risk is a lot, and the yields are not that great right now. Now, if that doesn't mean they won't work out. Like, if we get past this inflation thing and then interest rates fall again, long-term bonds will go up in value. But I personally wouldn't be buying them. I generally don't invest in long-term bonds. I usually am more in intermediate. I have the T-bills now in the no penalty CD because that's money we're going to spend in the next 12 months. This is correct. Yes. CDs are subject to state and local taxes. You got to factor that into your analysis. Would it offset the yield? It'll offset some of it, right? Sure. Absolutely. It's one of the reasons I have both. You've got, interest rates, where are they going to go, tax differences. So, yeah, it definitely absolutely should factor that in. They get very little Fidelity. I don't think the expenses are significant. In fact, there may not be any. I mean, I don't think it's any, actually, or it's insignificant. Treasury Direct is a pain to deal with. I mean, I buy my I bonds there because I don't have a choice. Honestly, I would pay, there could be a small fee, although I'm thinking about my own account. I don't think there was. But even if there was a small fee, I would pay it for the convenience factor, personally. Oh, you're asking, it's a no penalty CD that's paying 2.7, and I can show it to you. This is my site, allcards.com, banking. You'll find it in a lot of different places on the site because I think it's one of the best savings rates out there, but here it is. And they are an advertiser of mine, so full disclosure. But, if you said, well, Rob, I want to open up a Save Better account and I don't want to go through your links where you make money, I would say, okay, go to savebetter.com. No worries. There it is. There's a good offer right here. Money market account at 250. I think 253 is the highest money market I found, I think. But 250 is pretty strong. But no penalty CDs right here, 270. And they have some others. By the way, yeah, I mean, the 14-month, it's pretty strong. Anyway, yeah, there it is. Well, Marty, curious what you'd want to know about sequence of return risk. Yeah, I mean, it's an important aspect of retirement planning and withdrawal rates. We know that just looking at average returns and average inflation can be very deceptive. It's like I read this quote. I forget now where I read it, but it was like the math professor crossed a river. He was a statistics professor crossed a river that had an average depth of 3 feet, and he drowned in 10 feet of water. Okay, I thought it was funny. I don't know. Yeah, it kind of makes an important point, though. All right. Oh, vinyl. I am going to reach out to Wade Pfau, and I keep threatening to do it. I've interviewed him before, just not since I've had this YouTube channel. Let's see if I still have his email. I mean, I can get it if I don't. Just go to his website. No, I'll have to look it up. Wait a minute. Go here and see if I can find him. Huh. Oh, here he is. I do have him. I last emailed him. Is that right? Oh, no. I actually emailed him 2 years ago. So I will email him as soon as this live stream is done. You don't need to sit here and watch me type an email to Dr. Pfau. All right. By the way, I'm having the CEO of Fundrise on the show a week from Wednesday at 2:30. Ben Miller is his name. So if you have questions about Fundrise, which is a way to invest in real estate, shoot me an email with him. I'm sort of collecting your questions. And Yeah, I don't have any issue. I think a fund is probably very sensible. Absolutely. For me, I ended up with Treasury bills again for some money that's sort of outside of my investment portfolio that we're going to spend on a kitchen. I don't think that there's a wrong answer. And you can always sell them, right? I mean, there's a pretty deep market for treasuries. So, but yeah, normally I would own a fund as well. I don't. I So Swedrow and Bernstein say don't play the game, meaning investing in equities, if you have already won the game. I would assume you have won the game, so why are you still in equities? Well, what am I going to be in instead? And so someone would say, well, I guess fixed income, right? Cash, treasuries. But aren't those riskier than equities? I know they're not as volatile as equities, but long term, I'm probably going to lose money on after inflation basis, or it depends on the market. It could do maybe beat it, but not by much. And I can do other things to address the risks that equities entail. Risks meaning really volatility through diversification, no debt, things like that. And so the other thing is I don't really see it as won the game. I mean, I guess it depends on what game you're playing. If the game is survive, yes, we've got enough money to survive, at least as far as I can tell. But for me, it's more than that. It's giving to helping other folks from time to time, charities, and just being responsible with my money. And so we're not 100% equities at all. But the idea of like going 100% fixed income, that seems, I don't know, that just personally for me seems irresponsible with the money. So, by the way, I shouldn't put it that way. If someone wanted to be 100% fixed income because that's what they were comfortable doing and they had enough money to do it, you'd get no grief from me. Okay, what do we got here? Honestly, I don't think it matters. Is it beneficial to have VFIAX? Let me just make sure I know what fund we're talking about, right? VFIAX, right? In a Fidelity account. Well, you'll pay a fee to buy and sell the mutual fund version in a Fidelity account. You won't buy and selling VU, the ETF. So that's the difference. By the way, I don't mind necessarily paying a fee if I want a mutual fund. I probably wouldn't do it if I were sort of dollar cost averaging every month. But like if it was more of a lump sum and I wouldn't necessarily oppose the fee, but the ETF's going to be free. Welcome. Greetings from Manila. The T-bill yields are annualized, yes. So when you see 3% for a 6-month T-bill, that's not 3% in 6 months. It's 1.5% in 6 months annualized. It would be the 3%, which is how you can compare different maturities, right? Otherwise, it'd be a mess. Well, in my mind, it would be a mess. So, Martin, it absolutely could be, well, a single premium deferred annuity at age 67. I guess it might, maybe. But this is one of the questions that I want to ask Dr. Wade Pfau. That's one of the reasons I've been wanting to have him on the show. I'd like to understand, really there are two things. Annuities are on my mind, long-term care insurance. I'd like to come up with does he have a framework for when it makes sense, how much, for example, how much to annuitize? Those sorts of questions are on my mind for him. I could, Red, but I've actually never bought a single, I mean, I've owned a municipal bond fund. I've never bought a municipal bond. Um, I'm just looking on the Fidelity. Here's municipals. Man, there's a lot of them. Let's see. If we go to the end of this year, we get it down to 45 bonds. Here they are. One reason it might make sense to buy an individual municipal bond is if you want to buy it in the state you live in for tax reasons, potentially, right? And depending on your state, there may not be a fund that focuses on Delaware, for example, because of its size. You can see all the different states here. But yeah, I've never actually purchased a municipal bond. By the way, I'm watching Better Call Saul, the last few episodes. They came out, I guess, a little while ago. It's an intense show. What time is it? 8:26. All right. Going through your questions, trying to find some good ones here to end the show with. Well, so JB, I mean, in a 37% tax bracket, and then the question would be, what's your state income tax? But at that level, I would certainly be considering municipal bonds if I needed to have them in a taxable account. Kind of surprised you have a 401k with no viable bond options. But yeah, I would certainly look at municipal bond funds. I'd certainly consider them at that tax bracket for sure. Uh, hmm. I'm not sure I understand this comment, Vinyl. Taking qualified dividends in an IRA throws away a tax advantage. Well, but I mean, if you invest in stocks, you're going to get dividends. Stock funds. Nothing you can do about that, I don't think, unless I'm missing something. All right. It's funny that I'm behind in the chat. I always am. So things I said like 20 or 30 minutes ago, I see all the comments, now, like on the climate change, which is kind of funny. I really do try to avoid political issues on this show. Greg asks, if an initial 4% withdrawal in year one is more than you need, couldn't you forego an annual inflation adjustment? Well, first of all, you could forego an annual inflation adjustment anytime you want, right? I don't mean that just as a. I'm not saying that just theoretically, but I mean even as a practical matter. I think a lot of people could figure out a way to get by, at least for some period of time, without inflation adjustments. But here's the thing: if in year one you don't need 4%, you wouldn't take that out to begin with, right? You take out whatever 3.5%. And that will absolutely give you more wiggle room, flexibility down the road. And you're right, as a practical matter, regardless of your initial withdrawal percent, you may not need an inflation adjustment every year. Keep in mind, like a big part of inflation is gas, right? which, if you're no longer commuting to work, I mean, you might do some traveling, but, I can tell you the increase in gas has not hit us nearly as hard as it would have years ago when I was commuting and stuff. Although I did take public transportation a lot, but I drove some. It was basically like the lesser of two evils in Washington, D.C. Housing, it's now based on sort of a rent equivalent, but you may own a home, and so the cost of the home itself. Now, the other things are affected by inflation, like your insurance, your real estate taxes are going to go up, maintenance, but the impact of the cost of the home itself might be locked in. So exactly how inflation is going to affect someone could vary significantly from the actual CPI number. Also based on where you live. Anyway. Jeff, I was asking the same thing. I don't know. It's really unacceptable, though. What if I were late every week? I really need to demand more of all of you guys. Glad you could make it. All right. Well, with regard to T-bills, how hard is it to designate a power of attorney over the account? I would assume it would be at the account level. And I wouldn't think it would be hard. I guess it depends where you have the account. But again, it's not something I've had to do. So you're talking about not payable on death, not like a beneficiary. This is Fidelity anyway. How to set up a power of attorney. That might be helpful to you. I've never bought from Abe Books. Is it Abe or Abe's? It's Abe. Maybe I should. Anyway. DR says, you seem to have misgivings about each retirement distribution scheme you review. Which approach are you leaning toward at this point? Well, for me personally, my approach is to be able to live off of far less, such that it doesn't really matter which one I choose. That's my plan. But I also understand that may not be feasible for everyone. So part of it, I think, depends on how much flexibility you have in your budget. In fact, I wrote this article for Vanguard. See if I can find it. Here it is. I wrote this a couple years ago. The 4% budget, why spending flexibility is more important than withdrawal rate in retirement. So the idea behind this, and you can check it out, but the idea behind it was, you can imagine two people following, let's just say, the 4% rule. And one person needs every dime of that 4% in year one just to get by. And the other person doesn't. They need 2.8 or 3% or whatever. And the rest is fun money. They're going to travel, do some work on the house, go out to eat, go to some ball games or whatever you like to do. Those two people, even though they're following the same 4% rule, are in dramatically different situations. And so even if you're going to follow some withdrawal rule pretty much close to what it recommends, I would want to have as much flexibility as I could. Now, again, I understand situations may not allow that, but it would also inform when I retired. So if I got to a point where, yeah, I could survive, but I was going to need every dime I could squeeze out of a 4% sort of methodology, I would not be comfortable retiring. Again, maybe you don't have a choice, but and that might even just mean part-time work. So anyway, I just think that flexibility is very important. I have not come to a conclusion on like what I think is the best approach. I had thought for a while the guardrails would really be helpful, and I think they can be. But if you were to retire in the wrong period, like say the late 60s, you would find even with guardrails that your after inflation amount that you could spend each year could go down dramatically and stay down for decades, and maybe even for the rest of retirement. And that could be difficult for some folks. One thing that I've been noodling on is the Yale spending rule, and if that's a good balance. And the way it works is, you could imagine taking a 4% rule kind of approach where you're going to adjust for inflation each year, and pairing it with just a straight up percentage, say 5% a year of your portfolio. And what you could do is calculate your withdrawal distribution with each of these two methods. So with the 4%, once you got it going, you're just adjusting for inflation, and that gets you a dollar amount. And of course, that approach ignores the value of your portfolio, right? The, say, 5% doesn't ignore the value of your portfolio. In fact, the value of your portfolio is the other part of the equation, right? But then what you would do when you calculated these two numbers would be say, okay, I'll take, let's say, 70% from the calculation using the 4% rule, and 30%, I'm making these up a little bit, but 30% from using the 5% just fixed percentage rate and combining them. So you're kind of getting a little bit of both. And there are different ways to smooth that. You could take 5% out of the last year's balance, but 5% of the average of the last 3 years, which would smooth it out even more. And then, and then you could play with the percentages. I'm wondering if that might yield a withdrawal strategy that I would be comfortable with. But I haven't crunched the numbers or seen them crunched. I am wondering if Big Earn looked at that. I haven't gotten through a series yet. But that's kind of what endowments do. If you think about an endowment, they're very much like retirement spending, except that they don't have a 30 or 40 or 50 or 60 year time period. They want to live on in perpetuity. And they have to balance giving money to professors and students now for current research. They don't want to shortchange, the folks currently at the university. But they also don't want to spend so much that it cheats the folks 10, 20, 30, 100 years from now. And that balance is tricky. And that's kind of what they've come up with. If you Google Yale spending rule, you'll get plenty of. Actually, the very first thing you get is a PowerPoint from Yale. Let me pull it up here. Here it is. I haven't read this particular PowerPoint, but it kind of walks through the idea. So if you Google that, let me see if I can find a better actual article, though. Endowmentinvestor.org. I don't know how good this website is, but this is a description of the spending rule. So you can check that out. Again, I don't have any, I can't put my hands on data that back tested this. All right, gang, it's past my bedtime. It's 8:39. If I go past 8:45, I turn into a pumpkin. So I'm going to call it a night. As always, thank you for spending part of your day with me. I was looking for maybe some shows that some of you might have recommended, perhaps, but I'm seeing nothing. I don't know. I need some more shows to watch. Although we do have football now, so I got that going for me. I will have some more videos for you this week. And I've got that interview with Fundrise a week from Wednesday, so that'll be fun. I will reach out to Dr. Wade Pfau. Yeah, so that'll be good. So if you have questions for Fundrise or for Dr. Pfau, shoot me an email, let me know. I will add them to the list and ask them if I can. And I guess that's all I got. Hope you have a great week. And until next time, one thing I don't like about signing off of this show, I don't get to hear, it's not like a dialogue. No one says, okay, Rob, have a good night. Nothing. It's silence. I'm just sitting in a basement by myself. I can hear appliances humming in the background. That's it. I don't like that. It'll be fun to meet some of you at the Boglehead conference. Hopefully many of you can go. All right, now I'm done talking. Have a great week. Till next time, remember, the best thing money can buy is financial freedom.